Hello, everybody, and welcome to our next podcast, The New Barbarians. Today, we had set a defined schedule with some feedback from our production and crypto analyst, Christopher Rosa, about keeping us on task here. So we want to tell you early on that we are going to tell you what we think 2025 has in store for us based on what 2025 has in store based on what happened in 24. Last episode, we talked about what happened in 24 based on 2023's Bitcoin and US 10-year data. There was a lot of information in Bitcoin's history, starting with, say, Judge Rao's decision on August 29th, taking the SEC to task, which we spoke about, and how we thought that that was a real window on the eventual and inevitable Bitcoin ETF. Now, that was months before. No one listened. Today, we're going to talk about some things in 2024 that are likewise not priced in. But unfortunately, we got to rip the script, Chris, once again, because we had a big print today. So today's Friday, the 10th. We'll probably be dropping this on Monday. And I'd love to throw a graph up in front of you. And for those on a podcast, I'll walk you through some of the numbers. So Friday, January 10th, we had a unexpected blowout non-farm payrolls, 256 versus 140 or so expected, and unemployment went down. Unemployment dropped from a 4.2 expected to 4.1. What that means is that the economy's running pretty strong. It means that people are calling to question whether the Fed should have cut rates, and the market has voted. Today, as we speak, we have Bitcoin up 3.8%, along with other commodities like gold up 90 bips, silver up 1.1, Brent crude oil screaming up 3.2%, doubling their number on the year, up 6.2% on the year. Equities, on the other hand, down. NASDAQ down 1.4, takes it down on the year, the 10 days into the new year. S&P down. Nikkei down, and China just can't get out of its own way, down 30 bips, down 6% on the year. Bonds also down. So a real reversal, and we're going to talk about that. Bill Mann is going to bring in some insights into how some of the quants look at these dynamics that are emerging. I'm just talking about numbers. How is performance? But that's not exactly how everyone invests. Some people use factors and other metrics in order to make decisions. So that's on the tape. Now, we also talked about the dollar wrecking ball. All right, so let me double back. Equities are down because interest rates are higher. Inflation's running hot, so that rates are going higher. The 10 years now at 4.75, up from 3.61% when the Fed started cutting rates in September. So the Fed cut rates because they were worried about the economy. Well, they were wrong, it seems like, because the economy is running hot. And even though the Fed cut rates by 100 basis points starting in September from, say, I think it was 5.5 down to 4.45, you're seeing the 10-year do the exact opposite. The market does not agree with the Fed. That's the biggest macro point, and it impacts rates. Now, before we go into what we really wanted to regularly schedule this program, Bill, I want to kick it over to you with that thought about what happened in September when the Fed cut rates for the first time since hiking in March of 22, when they rose rates from essentially 0 to 5.5 in a little over a year. They cut by 100 basis points, and the 10-year, the market rate, went up by 115 basis points.
But how quickly did it actually go up? Was it overnight, or was that now? Like, how quickly did the yield curve steepen?
The yield curve steepened over a period of time. It did go, I'll put it this way, or not this way. What's remarkable is that rates were going lower as if there was a concern in the market. So when we look at our chart that we have up here over the past 5 years, we see that rates went down from, say, 4.5, the 10-year, down to, say, 360 over a couple months. The Fed then started cutting rates in September. But at that moment in September, when rates hit 360, they only went up, Bill.
Yeah.
So it was pretty sharp.
So yeah, you can see it on the chart now, and I think you can just say the 10-year is also a proxy for the yield curve slope, since the 2 year is so close to short-term rates anyway. So you can see the Fed cut after the yield curve flattens a little bit for like a month, and then immediately it starts going back up, and I think that is the market pricing in some of this uncertainty around the Fed's policy. And then we saw a lot of markets reacting to that, and then the election, and there were a bunch of things happening in the last quarter of 2024 where originally I think there was a call that the Fed may cut rates 2% through 2025, and then there was a lot of speculation about that being too dovish, and yeah, it looks like that's playing out now.
Yeah.
And then just today, I think we're also seeing the same reaction in the stock market. So when you think about factors, sensitivity to inflation, sensitivity to oil price, those are the only factors that are performing. And, there is a 2 sigma move for both of those factors today. So, in one way.
Well, so we have promised to catch each other when we use jargon. I know
Sure.
you're going to do it to me. So when you say 2 sigma move in oil, what does that mean?
Sure. So when we talk about sigma moves, what we're really talking about is, there's a return today relative to history that is larger than we would expect. And so these are statistically significant. People also think about them as z-scores. And so the when you have a 2 standard deviation event, it is, by definition, statistically significant. That's when people start to notice. Otherwise, it's just kind of noise around what are normally volatile assets. And the stock market is certainly one of them. And all of financial assets are. So one way that, and these aren't quants, these are just statistics. This is going back to, statistics 101 from college or high school, even when you learn about standard deviations. So what I'm really saying is that the stocks that are sensitive to inflation or sensitive to oil prices are showing a statistically significant return today. So a lot of people react to this news and they buy these stocks that they expect to perform well when inflation's going up or when the price of oil will go up. And presumably the same is true with other commodities.
And so, Bill, you're saying that oil experienced a 2 standard deviation move today on Monday?
Correct. Yeah.
All right. So let me
stocks
in layman's those stocks are in layman's language, or not layman's language, for my brain to process that. I'm looking at the original price chart we have on what's going on today that we kicked off the show with, and we said oil's up 3.2%, doubling, bringing year to date up 6%. When I look at the what it made over the past whole year, 12 months, Brent made 3.4%. It is compounded at about 4% a year. So to make that in one day is unusual, is what I guess what you're saying.
Exactly. So what you do is you look at daily returns, and then this would be statistically way more than you would ever expect in a day.
Yeah. So with that information, what would a quant do? It's unusual. Do they sell it? Do they think it leads to a new regime and they should buy more of it?
It's a great question. Typically, quants aren't going to do anything on a daily basis, right? So the models are meant to, perform regardless of what happens in the stock market and in, the macro economy. Having said that, there are strategies that try and time factors. And so, this is hard to predict, but if you did have predictors that could help you position the portfolio for such a macroeconomic change, you would hopefully have done this before today, and then after today, some of these stocks will become momentum stocks, and then, you'll probably end up betting on some of them for that reason. And so the stock markets, the stocks in the stock market will evolve a bit with their exposures to these different risk premia. And today, the ones that are exposed to the price of oil are going up.
Well, the movement in the markets are really causing quite a stir all over. We're hearing yells from across the street. The animals are starting to howl at the moon here.
That was a puppy.
That's awesome. Thanks for that. So sometimes these signals need to be seasoned. They aren't actually actionable. They just go into the rubric to be ingested, and maybe there's a trend, maybe there's not. But it depends on the type of model.
This is, I'm using a lot of fancy statistical jargon and quantitative research. But I think what you see on a day like today is consistent with what Wall Street's always done. 30 plus years ago, there would be, someone running from the Fed to like a payphone so they could call the desk and tell them, and they would literally hire someone that was like the fastest runner to actually deliver the news, and then people would all react appropriately and buy bonds and buy longer duration or whatever the appropriate response is. And I think that's just what we're seeing. Yeah. What we are really talking about, though, is the Fed getting surprised about the economy, and they probably moved too soon, or hindsight's 2020. We'll see what happens in 2025, but that's a pretty big day today.
It was a big move. Speaking of that, maybe we'll go back to our regularly scheduled program about in both Bitcoin and 10-year, looking at what happened in 24 to inform what's going on for people in 25. I think some of our information we already hit. So Chris, if you can cue up that Bitcoin price and related events in 24, we're already seeing Bitcoin separate from risk assets. It's up 3.5% and climbing today. It's up even more than we started our call, as equities drop. So funny that Bitcoin is seen as a long duration asset, but actually now it's trading like a commodity, something that benefits from inflation and potentially debasement. So to get more sort of insight, and as you said, Bill, there's one day of information doesn't make a pattern. So that's why we like to go back and look at a series of events. So for those of you not getting the visual here, but on a podcast, we have the full 12 months of Bitcoin price that started out at about 44,000 in January of 24, right before the January 11th announcement of the spot ETF. And the spot ETF was definitely a sell the news. And it dropped about, I think, 29%, I think, into early Feb before rallying up and finishing the year up 120%. So there are three segments for those not here. There's the eventual run-up of Bitcoin from 44 to 73 in the Q1. Not in a straight line. Bitcoin's not like straight lines. And then there was this guy named Check. I think it's James Check, who used to be on Glassnode. He dubbed this March to November 8-month period chop solidation, and I love it. It was a 32% price range between, say, 73 and 49, and it had a terrible downward trajectory. I mean, it's a terrible chart. I mean, if you're looking at this in September after Trump gave a great speech at Bitcoin and you think it's all going higher. It just looked horrible. And from that point on, that September low, it then peaked at 108 in early December before trading off. So that's the three parts. Q1 straight up, chop solidation, Trump gets elected, off to the races. But behind the price, let's look at some of the events. And this is where politics comes in. 23 was about the legal side coming through and getting clarity, and it was about new industry players, BlackRock, Fidelity, emerging, and all the bad actors like SBF and CZ being taken out. That was 23. 24, it's a political battle now. You had, in May, you had both, Bill, you had Congress come in for the first time ever and have a consensus view on crypto. They said, you know what? SAB 121, which was a SEC edict handed out years ago that said, you know what? We don't really know how digital assets work in bankruptcy. We don't think that a custodian, that you can really custody these assets. You have to, they basically made it hard for any financial institution to separate digital assets from the rest of the balance sheet, like a Coinbase. They had to bring them together. So you basically could lose your assets if you were custody with Coinbase. They're saying in the bankruptcy. It could be a general unsecured creditor. It's the kind of stuff no one wants to hear. So that's what the SEC did. Congress said, that's BS. We should roll that back. Biden vetoed it. Another time when politics came in after Trump spoke at the Bitcoin conference, I think on the 29th. I have the 27th here, but I think it was the 29th. He mentioned hold on to your crypto to a Bitcoin audience, which is awesome. Everyone's like, no, it's Bitcoin, not crypto. But anyway, he's learning. I think Barron's been teaching him since then. So he came in, spoke, said he's going to set up a Bitcoin strategic reserve on day one. He's going to make it a priority. The next day, coins move. The Department of Justice coins move out of their wallet onto the Coinbase exchange as if they're going to be sold. So it was a total signal by the administration to push Bitcoin down from 70,000, which it rose up about 12, 15% when Trump was speaking. It was a way to take the air out of the sails of Trump's embrace of crypto, and it went straight down as his chart shows. So this chop solidation without clarity, I think is why what I see here is an administration with a mandate that's not fully priced in yet to Bitcoin. And then the last part I'll talk about, what 24 tells us, is that MicroStrategy's being added to the NASDAQ 100 after it ingested tens of billions of dollars worth of Bitcoin. It shows you the power of what Bitcoin can do to your capital structure. That's another topic that we're going to bring up. It probably needs 2 or 3 podcasts to understand exactly what he's doing there and how it has driven his firm from $1 billion to over 100 billion now, back down to 75, 80. So that's the review of 24. And what I get out of it is that just as 23 saw scoundrels out, good actors in 24, we have now political scoundrels out. We have Biden vetoing consensus legislation and Trump in supporting it. That's ginormous, not priced in, and why we still think Bitcoin's a 250 to 450 number in 25.
Thank you, Mark. I guess I would also add to that. Today is one of the days when I saw crypto going up when the equity market's going down. And, a lot of times you just see this risk on, risk off behavior. So today it's actually behaving as we would expect. It is an inflation hedge. So when inflation is going up and we think rates are going down too much, it's sort of behaving the way we expect it to. And then I'd actually like to go all the way back to what I said about things behaving the way we expect. It wasn't always the case that good news about the economy was bad for the stock market, but that is true today. So the stock market's down, but certain sectors are up. And the ones that I mentioned earlier that, sensitivity to commodities and oil are up. But overall, the stock market goes down when the prints about the economy are good. And the reason for that is because it's all driven by Fed policy and pumping liquidity into the system. And so basically the expectation is now that maybe the government won't cut rates as much. Maybe they won't print as much money. And so the stock market doesn't like that, even though it's good news for the economy.
All right. So do you think the Fed won't pump more in, or do you think there'll be a reason why they have to come to the rescue of little Johnny or little Mary again?
So, I think we may need new reasons to inject more money into the system. And the most obvious one would be, if there's a private credit issue, or if the actual credit cycle is to return or something like that. But we have a good economy, so I'm not sure what the excuse will be. But yes, I do believe the government will support the economy at all costs, and that may include global assets rather than just the U.S.
Ah, right. So that goes back to the dollar strength that we talked about earlier. So staying on the idea about what you said is at first, it wasn't always where something good for the economy was bad for the equity market, and we need to have the Fed come in. Two thoughts on that about 20, which I think you have some information on about 25 in equities. 2024 was about multiple expansion. Earnings were up a bit, but it was more about PEs expanding. Is that fair?
2024, correct? Yes, price went up. The PE went up more than would be justified by historical valuation.
And now are we expecting to have it more about earnings going up with potential? And is AI a factor in that, or are there other dynamics that you think would have an earnings?
So the outlook for the economy is good, as we have just said, and so AI and a lot of people talk about that and its impact on the bottom line, and I have no doubt that it's going to save a lot of money, and companies will be more profitable. But I think, yeah, the overall outlook for earnings is up this year, so that should drive the stock market higher. All else equal, if valuations kind of stay where they are, the denominator goes up and prices should go up. So there probably won't be as much inflated asset prices as we witnessed in 2024. I think it actually normalizes things a bit for earnings to catch up with the price appreciation of 2024.
Got it. Yeah, so that could be a healthy thing to backfill those expanded multiples. So following that point about the Fed, the one thing before we leave the macro and the top down, and we're definitely going to dive into some detail here, the concern that I have and why I think Bitcoin is up today is in the background. If rates stay here, you have a federal balance sheet that's now got $36.2 trillion of debt, up from $23 trillion before COVID started. And when COVID started, rates were lower. So what you have now is a larger debt load at a higher rate. And that's not fully priced in yet because the Treasury is still living on those lower rates from days on past, but I think there's $7 trillion of debt that is going to be refinanced this year. And that, is, arguably 20% of the or so of the debt load, I think that's going to be about 200 basis points higher. That'll come in. That can push our deficit lower or more negative. And at a point in time, the Fed may have to come in and do a QE or an Operation Twist in order to really keep that 10-year down. Because if no one's buying it, because they're worried about maybe our ability to fund it, there's credit concerns on us, but we're still the best option because we're the highest rate and we can always print money. So there's a bid for our short-term debt. They may have to be the buyer of the long. So Bill, that's where I think potentially they come running because of our own goal of having higher rates that we can't afford.
So, I can definitely see us doing that, as well as issuing more short-term debt. Like financing long-term liabilities with short-term debt is a classic way to, run a bank, right?
Let's go. That's it.
So I do, yeah. I think the Fed will do whatever it takes to support the economy, and
I love the Drahi reference, pulling back. That's it, 2012. Well done. I love having veterans on here, working with veterans. All right, so let's go. That was 24. We talked about rates. We said that, we've been in a sort of a persistently high rate environment here. We don't think the U.S. can afford it much longer. The Fed sort of lost the plot by cutting rates while the economy was still very strong. They missed that. Market voted. It's going higher. The 10-year voted. It went higher, well ahead of this print. So the market was smarter than the Fed. That's what we think. So equities who are relying on lower rates are trading off right now, but maybe earnings bring them back higher. So do we have some information, or should we just read off, Bill, I think something that you shared earlier with me on some of the consensus estimates that you had across the street as we continue to look at 25?
It looks like I was just laughing at myself a little bit. It looks like, there's consensus for equities to be up like 10% this year. And I remember when that was a lot, and we've had 2 years of 20 plus. And I guess that is actually going back historically to like 1998. We haven't seen that, but 10% actually doesn't even sound like that much anymore. Like we live in this, sort of crazy world where, and forget about getting into inflation and like real returns and stuff like that. But it looks like, there's definitely consensus that equities are going to go up, and, 10% is meaningful. And then I think you can also see on this table that, earnings growth is pretty much also consensus. What else? It's pretty much just, earnings are going to drive valuations higher. There are a few, I wouldn't call them even bearish outlooks, but they're less than 10%. So, so coming from such a high valuation, I think that that's a reasonable thing to outlook as well. But chances are, the gravy train continues.
Yeah, and there are some people trying to distinguish themselves here. I see. I see 2 or 3 things I'd like to point out. First is a bit whimsical. Bank of America has their target. Can you read out what that target is?
6666.
So, besides one-upping the sign of the beast, what I remember is that 666 was the low on March 9th of 20, when Citibank was at 99 cents per share before its reverse stock split. And that was also the day the Fed reversed and just started going gangbusters because banks were failing and the sign of the beast emerged. So just a little history there for everybody. I remember looking over my colleague's shoulder, Chris Winham, and he said, "Come here, Mark, look at this." I was risk managing a hedge fund. And he pointed at it. I I thought it might have gone lower, but he was a little wiser. He said this might be the low.
So resistance or support at the
Support and
sign
help.
the sign of the beast. Yeah, exactly.
How
The
great. They must have had to go through compliance to put that in. I know how banks work. They're like, no, we can't do it. Come on, guys, let's do it. It'll be funny. So that I just wanted to point that out, a little historical perspective. And also the S&P means it's up 10 times. Is that right?
like when you said that, I remember when it got back to 1,000 and it was a big deal in 2009, and you know it's crazy. I think I've said before, I was obviously shell shocked after the credit crisis coming out of AIG Financial Products, and the early on in my career it was the tech bubble. So to look back 16 years plus now and see that the market has just continued to go up and up and up is crazy. 10x.
10x. Awful low. It didn't spend a lot of time there. The reason I brought it up just for the whimsy and the fun of it, and just show perspective and context, but also when you said 10% used to mean a lot. And I think there's a reason behind that. Sometimes you feel things before you see them. And your feel on that, which I think you also have some insight there, obviously, we talked about it, is that in this decade, the monetary base has grown, I think, a little bit over 10% per year. So one way to look at it is, if you think the supply of money, your returns need to meet or exceed the supply of money to maintain purchasing power. I'm not going to get exactly, too deep into it, but people should be curious about it because you are feeling the slipping power of your wage, probably. That's why 10%, I think, doesn't feel like a lot, because of the monetary base growing. It used to be 5%, 6%. Now it's 10.
Yeah, I totally agree. I guess I was not kidding when I looked at that table and said, 10% doesn't look that great. And when you mentioned monetary policy also going up by the same amount, I'm sure a lot of people are familiar with this concept when they look at how much money they make. And, if you get a 10% raise every year, you'll double your money in 7 years with the compounding. So that also just means that, money supplies, the monetary base is doubling every 7 years. And, the stock market needs to at least follow that.
Yep.
And, maybe have a multiple on top of that.
Yep. And it wasn't always like that. So, yeah, this is, talk about consensus. And that's the biggest insight. Yes, it's earnings driven. PEs will be, substantiated by more earnings. Good. But you may just be kind of maintaining your buying power at 10%, which is something that, we've been speaking to registered investment advisors and others about. You can't look at nominal returns anymore. Are your clients maintaining their buying power of insurance, of their Florida condominium, to be able to maintain the new costs involved with shorefront property down there? How are you servicing your clients? And I don't think 5 to 10% fixed income returns or private debt are getting you there, let alone equity. So
I would also add that it's become second nature to a lot of people now, and perhaps non-quants as well, that the stock market's going to go up 10%. Some sectors and risk premia, again, to go back to the quant parlance, will pay off more than others, and so when you see the stock market only going up 10%, you can kind of expect the value stocks should do well, quality stocks should do well. And again, it's going to be more of a stock pickers market. It's not just, buy the index and earn 20% this year. It looks like, you have to do a little bit of a better job picking the stocks that you like and don't like.
Yeah, thank you. That was the second part. I'm glad that you brought me home to it. In particular, I think it was RSI, Evercore ISI, talking about tactical opportunities.
Yeah. And so, again, getting back to like what do quants do short term and medium, long term, they'll kind of follow trends and bet on everything. But certainly if you're tactically setting things up, and this is what my outlooks typically are doing when I publish research, is I'm looking out over a quarter and the year, and then I'm kind of rebalancing that tactical outlook. So what are you going to invest in the next 3 months? And this is, perfect opportunity. We have a really good idea of where the economy's going. And, I just said which sectors I think will do well. And so what the next stage for me from a tactical investing standpoint, in addition to pursuing relative value trades in crypto, I'm still certainly in the more traditional space within
Hmm.
equities. So, I'll buy ETFs that give me those exposures. So, value stocks, sector specific stocks, and, sell the ones that I don't think will do well. And then, go short where I think they'll go down. And then over time, I also am building more of my quantitative tools to do, more stock specific picks on the long and short side. But the first step is figuring out which quantitative risk factors I think will outperform and underperform over the next
And
month
then with
or three
that, you could
months.
show the names that quote load high to those factors, right?
Correct. Right. So, if you just wanted to bet on the value factor itself, you go long the good value stocks and bad the bad value, and you short the bad value stocks. But my outlook is more concentrated. So I'm just going to buy good value stocks, and
Yep.
I'll probably sell bad growth stocks, and kind of
Got
mismatch a
it.
little
Got
bit
it.
like that. But take a much more tactical outlook based view on the sectors and single name stocks that I like and don't like.
And with the ETFs, you can single name, but with ETFs, you can probably get a fair. Well, can you get a fair amount of that punch to the factor you're looking at by trading that? Yeah. Okay.
Yeah, and some of the smart beta ETFs are so cheap now that um, you can get this quant exposure, and it won't be the same alpha that you get at a hedge fund or even a long short mutual fund. But if you want exposures to those specific risk premia, it's very easy to find ETFs. And um, I think last quarter my outlook did pretty well, and it was all expressed in ETFs. And you bet on sectors, regions, and quantitative risk factors, long short, and you know you take a very diversified view, betting on everything. But yeah, I think you can certainly get those exposures with very cheap ETFs.
All right. One big area we talked about yield that we didn't touch on, and I'd like to know if I can try to jam both the bond outlook, and then I did want to touch on the dynamic of Bitcoin's volatility and how that's attracting some new players into this space.
I'm still a new player in the space, and I'm, like even just today, I see that it's doing what it should be doing, and I'm a believer.
All right. So in the bond side, do you want to show your outlook? And the reason why I'm pushing this is because the 60/40 portfolio, people still use a lot the bond ag. They use which has an ETF AGG. They use TLT as a proxy for yield, and I think, or when I look at some of the consensus, it is so unexciting Evercore, again, I like Evercore's work. I'm not picking them out because of that, but they have rising long-term bond yields post-challenge. Well, they should celebrate that one because that was printed before today's 15 basis point rise in the 10-year. JP Morgan's carrying the flag, though. They say that Fed's going to pause, but then cut rates further. Not sure how that's going to stand the test of time, unless there's an event like we talked about.
And
anything else?
The factors next to that say risk on environment favors loans, high yield, emerging markets. So, go for it. That's the only thing that does freak me out is when people say things like, oh, grandma's talking about stocks and it's when everyone's bullish, then that's the time to sell. And like I said, that's been freaking me out for a long time though. So, I would truly be an old man if I was calling this to be a bubble that's going to burst, because I certainly don't think this year would be, out of the last 16 so I do think that this all makes sense, except for some of the short-term noise that we're going to experience with days like today, and hopefully some of these outlooks will be updated with more data that comes in, but I wouldn't expect really material changes in these outlooks from the banks and the asset management community.
Got it. So before we close up, let's go into a dive into volatility, about something that I think will drive more engagement and adoption of Bitcoin more broadly, besides a very accommodative administration. And Chris, I don't know if we can bring up that. Oh, good, that chart there. And then Bill, let's land the plane by talking about what you think equities, bonds, and Bitcoin or crypto. Let's get some specific numbers, what you like, and what people can expect maybe a quarter out. So before we hit those final numbers or that final assessment on either what you think the street is saying or what you want to offer, this is part of a 4-year project that I've been doing in crypto broadly, but in Bitcoin more specifically. And when you have a large asset manager with a pool of securities, they're not really stock picking sometimes. They say, let me get a pool of securities together and rely on this thing called modern portfolio theory, because if I get a bunch of stocks together, I get something called diversification benefit. Some go up, some go down. It's like having a lot of kids. Some kids are getting A's, some kids are getting detention, but overall it might be a good day. You can't rely on one thing. The problem with that recently is that bonds have not been really playing well. On average, I think bonds are down over 5 years and 10 years in the middle range. And they exhibit a behavior of more bad volatility than good volatility. And so what I'm doing here, and I'll explain it. People think risk is bad. Risk is not bad. Risk is uncertainty. But the reason why in the marketplace people associate risk with bad is because in bond markets in particular, you take the escalator on the way up with coupon payments each year. And then if there's a default, you take the elevator shaft down. So the only type of uncertainty is bad. It's called left tail risk, fat tail. In equities, it's a little less so, but you do have incrementally higher good days. And then you'll have a sell-off like today, or like an 2008, or like a COVID, or like what happened with healthcare when Trump won with pharmaceutical companies. You'll have a 10% down day. That's why risk, as defined as uncertainty, which is what it should be defined as, is associated with bad in financial markets. But that's not the case with Bitcoin or even gold. As a commodity, it trades differently. It's a globally distributed, that I think is part of the reason why. But let's look at the data. For those of you not in the podcast, or on the YouTube, we have, for example, U.S. large cap equity good volatility. What happens? How much uncertainty is there over a an annualized basis, 12-month annualized basis? In this data, I think I used 5 years of data, 7 years of data, I think, and it shows that the standard deviation is about 9.5%. That means that on good days, the variance will be 9.5% higher than what you expect. That's what it means. The uncertainty is 9.5 percentage points on an annual basis. But the bad volatility, using data only of down days, is 14.5%. That means that you will expect 14.5% loss on an annualized basis. That is not, that's bad symmetry, more downside than upside. And bonds are similar, not that different in this sample, because bonds started to make a comeback with coupon. 3.9% versus 3.8. Our previous sample was, I think, 4 and 2. So again, more downside uncertainty than upside. This is much better to watch than it is to listen to me talk about numbers, because it really pops off the screen here. On the lower left, we show Bitcoin's good versus bad volatility. These are quarterly returns of a sample I did that I can share with that I share with clients. The good volatility for Bitcoin is 112. The bad volatility is 38% annualized. It doesn't even enter, people don't even know what that means because they've never seen it. And gold is 34 versus 6.5. Similar symmetry, but lower absolute volatility. The reason I mention this is because you have a firm like MicroStrategy, and what they've done is they have bought Bitcoin, they own it in their capitals, in their firm, so it's driving the value of their equity and their debt, and now their preferred stock, which is coming to a theater near you. And volatility participants are looking at the stock trade differently than, say, Bank America stock or Exxon stock, which has negative skew or has more downside volatility and upside volatility. So Microsoft has injected a moribund capital structure. Michael Saylor actually said we were having an existential moment in 2020 and we weren't making money, we were insignificant, so we bought Bitcoin. Not only did it go higher, it's not that, it's that looking at each day's movement, it now starts to look like Bitcoin, and these volatility traders couldn't own Bitcoin until recently. So I leave that with our viewers to get curious about it. It was on our 2024 chart about MicroStrategy entering the NASDAQ 100. So now the NASDAQ 100 has more positive skew because it has MicroStrategy in its index. So Bitcoin is slowly having its impact broaden because of inclusion in corporate structures like MicroStrategy or in indices like NASDAQ 100. So that's why you're going to see more adoption, because people are getting curious about how is this happening and can I do it too? So Bill, that's what, I don't know if you have any opinions on how this would factor in, like in the volatility factors or other dynamics that you measure.
So I think it's important to mention that we are not providing investment advice. While MicroStrategy and its story is a good one, when you look at this chart, it is an equity vehicle to buy Bitcoin, and I would argue it's like a levered Bitcoin trade. So, and a lot of people are getting exposure to it through bonds and converts and stuff, and we can get into that another time.
Yes,
but
and I agree. Bill's not just saying that to cover our butts. We are not giving investment advice about whether MicroStrategy ever is a good thing to buy now, for sure. Thanks for bringing that up, Bill.
Yeah, but it is a cool topic to cover in detail another day when we really talk about the dynamics of issuing debt to buy this asset, and it seems to be working out. At least the market likes it. So getting specifically to this chart, this is really why I bought. There were two reasons why I bought the Bitcoin ETF. Was because of this chart and because of the supply demand. Again, I've mentioned in the past that it's a classic microeconomic story. Supply's going up, or sorry, supply's not going to go up, and demand is going up. So it's going to go up in value. And then the positive skew here, which just means it's very risky and volatile, and that used to terrify me. And the risk manager in me was just like, I don't like volatility. But when you talk about risk and volatility, risk return, that's how you get returns, by taking risks. It is a positive risk, over a pretty long period of time. So to the extent that that stays the case, it's certainly the type of thing I like betting on. And you compare that to other assets with, the real downside skew, and we won't get into more quant statistics stuff, but that's like fat tails. And, what you want to avoid are these huge bad events where, your 401k goes down a lot and everyone's invested in equities. And that chart scares, certainly side by side scares me a lot more than the one that has good vol. And I kind of like that term as well. And I guess I don't know if it's time to really provide this, but I think one thing I'm hyper focused on right now is in the crypto space outside of Bitcoin, which, I think we both like, and there's that supply demand microeconomic story there. I'm also looking at fundamentals for altcoins, and in particular trying to find the relative value trades of one versus the other. So we've recently been looking at the different types of altcoins that are out there, and where we believe one will outperform the other, and where some may have more problems in the future. So that's where I'm really excited to just apply classic quantitative investing principles to the crypto market.
Bill, with some of your outlook, some of our macro approach, and I'll kick off, and Matt, why don't you finish up? We talked about equities up 10%. If I had to put a bow on this one, I'd say probably 10% in the aggregate. It's going to be messy because rate volatility is my number one deliverable for 25, my number one call. There will be interest rate volatility. What does that mean? It means that the actual nominal yield of the 10-year will be having a range of somewhere between 4 and 6%, 3.5 to 5.5%. And that the bigger part is that its relative movement versus other countries is going to be even greater. Other countries are now hitting growth problems. They've been trying to cut rates, but now they're having problems because the dollar is going higher and they're getting killed. So rate volatility will cause opportunities for folks like you doing factor and based and relative value trades. That's the number one opportunity in equities. Up, but boy, will it be messy, and there'll be rotations. And then on the digital asset side, I think that there'll be more industry developments. The Bitcoin reserve, I actually don't even want it because I think it'll concentrate Bitcoin. I'd rather not have it. I think it's a probability. But more constructively, I think that banks will be allowed to custody and trade digital assets. That'll happen in Q2, I believe, and that will be off to the races. You'll then see people incentivized to really move and promote Bitcoin. And boys, Wall Street love to sell. So those are my two predictions. A messy equity market higher, and more players getting involved on the adoption side of Bitcoin, and as you pointed out, digital assets broadly.
So yeah, I think we're going to tend to share a lot of the macro outlooks, especially when we're looking at the same data. So I won't repeat a lot of what you said. I agree there's going to be volatility in the equity market, and it'll probably be easier to go and get the report that I'm now going to be on the hook for publishing by the time this podcast gets posted. So I will provide more in-depth outlooks about sectors, quant factors that I like and dislike in Q1 as well as 2025. But, I've already touched on some of this quality value. And then, rate sensitive assets should outperform. There's my puppy again. Buster.
So rate sensitive assets will outperform. They'll move more, but you mean higher rates?
Yeah. So
just like your dog, higher rates will be getting more attention. Is that what we're saying?
The dog is distracted me. Yeah, I don't think rate sensitive assets will necessarily outperform. I think they'll be more volatile around these events. But like I said, I'll work a little bit more on my research and then publish it, and we'll share the way to find that in the notes.
Awesome. All right. Well, that's a wrap, folks. You'll be getting this probably on the 13th. This was employment and jobs data day, so that's why we were focused on the spike in rates and the drop in equities and the outperformance of Bitcoin and crypto. Remember to subscribe to this. Hit us up, follow our research. Bill, do you want to tell people where they can find you?
Sure. My website is harmonicinsights.com. That's HARMONIQ. So harmonic spelled with a Q. Insights with plural.com. I publish a blog there, and that's where I will put most of this research. I'm also on smartkarma.com. And so over those venues, when I talk about something here, I'll make sure that you can at least find it on my website.
Nice, thanks. And I've done that, and Bill's and Chris's work has helped me get up the curve on what AI models to use. And for my work, you can follow me on Substack on Mark Connors, and clients know where to reach me on my website, riskdimensions.net. All right, thanks all. Anything else?
I think that's a wrap.
Great. Take care.
Thanks.